If you're an incorporated business owner or professional, relying on an RRSP alone may mean overlooking other retirement planning options your corporation can support. Two strategies worth exploring are individual pension plans and retirement compensation arrangements. They can add flexibility and planning opportunities beyond the usual approach. An individual pension plan, or IPP, is a defined benefit pension plan set up by a corporation for one person or a small group, often an owner, executive, or key employee. In simple terms, it's usually most relevant for incorporated people who earn T4 salary rather than taking all of their income as dividends. A retirement compensation arrangement, or RCA, is a separate planning strategy that can help supplement retirement savings beyond the limits of registered plans. It can be especially useful when income rises above typical IPP thresholds, or when someone's situation falls outside the usual age or plan design range for an IPP. For many people, an IPP tends to fit best when they're roughly age 39 to 71, have strong T4 income, and may have years of past service that can be recognized. An RCA often enters the conversation for higher income earners, including executives or key people whose compensation is above what an IPP can fully address. That said, suitability always depends on your income mix, age, corporate structure, and long-term goals. These are not one-size-fits-all solutions. These strategies are getting more attention because the planning landscape for incorporated Canadians has changed over time. Changes tied to tax integration, passive income rules, and tax on split income have made simple keep-it-in-the-corporation planning less straightforward than it once seemed. For some business owners and professionals, that creates a stronger reason to look at more intentional retirement and tax planning strategies instead of relying on one tool alone. Compared with relying only on an RRSP, one potential advantage is that contribution room may become more meaningful as salary and age rise. In many cases, corporate contributions may also be tax-deductible, which can make these strategies attractive from a business planning perspective, as well as a retirement one. Depending on the structure, there may also be payroll tax efficiencies and more flexibility around how retirement funding is managed over time. For some incorporated clients, these strategies can also help reduce passive assets inside the corporation and support broader long-term planning. Beyond retirement savings, these strategies may sometimes support business purification, transition planning, and creditor protection, depending on how the plan is structured. In some situations, they can also play a role in intergenerational planning or help retain key people within a business. The right fit depends on the details. It's important to remember that this is general information only. It isn't legal, tax, accounting, or actuarial advice. Before making any decisions, you should get personalized guidance based on your compensation, corporation, and retirement goals. If you'd like to find out whether an IPP or RCA may be suitable for you, contact a wealth advisor at TVH Financial. Call 647-727-4668 or email financial@tvhgroup.ca to start the conversation.